The fair value gap, one of the biggest trends going on in the trading space right now. And there's a reason for that, because of how well they work in the market. But not all fair value gaps are created equal. For instance, this fair value gap ended up not working, and this fair value gap did end up working. So why did this fair value gap work and this one didn't? Well, there's actually a secret technique I use to instantly tell me when a fair value gap becomes valid. And once you add this technique to your arsenal, you will instantly see your fair value gaps become more accurate.
I am the chosen one.
To begin, we first have to go over what a fair value gap actually is. We can have bullish fair value gaps and bearish fair value gaps. A fair value gap is simply when price moves up or down an insane amount, creating a huge candle. The price moved up so quickly that it actually didn't give sellers enough time to counteract this movement, creating an imbalance in the market. Naturally, sellers will want to retest this zone. You can mark a fair value gap by simply marking the candle's top wick before the big move to the candle's lower wick after the big move. This zone is the fair value gap itself. If you look at your chart, you will see these gaps everywhere. Oftentimes, price will want to come back down to this zone, fill the imbalance, and retrace back up to test the highs again, which we can use to our advantage and profit off this move. But if you've ever traded fair value gaps before, you'll quickly notice it doesn't work 100% of the time. This is because you've probably traded an invalid fair value gap. But what makes a fair value gap valid? Well, there's actually 6 key factors that need to be true in order for a fair value gap to be valid. The first one is the fair value gap must be unmitigated. What I mean by that is, since the whole point of a fair value gap is to have price surge and not give the opposite side a chance to react, this zone must not be tested in order for it to work. So here, right after the fair value gap was created, price came back down to it directly after, then continued to rise. So if price came back down to the zone again, we would not consider this fair value gap valid, as it's already been tested here. If you want a fair value gap to be valid, it must be unmitigated and not have been tested before. Moving on to point number 2. The second way to see if a fair value gap is valid is by making sure to check the reaction of the candle inside the fair value gap. We want the reaction of the candle to either close inside of the fair value gap or for it to close in the direction of the zone. So here, the candle broke through the fair value gap and ended up closing below the gap. If this happens, this makes this gap invalid. What we want to see is something like this, where price closes in the fair value gap, giving us a safe entry. It's completely okay if a wick goes through the fair value gap like this, but ends up closing inside the gap. As long as the candle closes inside the gap or in the direction of the gap, we are good for an entry. Moving on